Fed week has come and gone, and with all honesty, it's left us with more questions than answers. As we kick off this glorious Friday, 30-year fixed is up slightly from last week, 6.83. As we open the markets this morning, 30-year fix is sitting at 6.88. And yes, this week we'll cover on what the Fed did, what it means, and really where we see things going from here. And I want to close with our agent tip of the week and really kind of outline what the Fed does and what our clients are asking. So let's jump into it. As I mentioned, a ton of questions and not too many answers. As this week, as we know, the Federal Reserve concluded their meeting, and by no surprise, rates were left unchanged. There was no surprise walking into that. Market fully expected it. And yes, the Fed delivered. But with that, as I open, more questions than answers, as the overarching tone from Chairman Powell was around wait and see. And by a lot of dissent, the market doesn't necessarily believe or expect that the wait and see approach is appropriate here. So let's dive into that. First and foremost, prior to the Fed, we had the monthly 10-year note auction. And not to get super granular on what that is, it's essentially each month we take to market, we being the United States, our debt through the form of treasury coupons and sell to open investors. Huge appetite for the investor community on the 10-year treasury. Is actually one of the stronger ones we've seen in recent record, which is a very positive leading indicator. So that dovetails into really what Chairman Powell and the Federal Reserve put out there, is that, the wait and see approach is that there is undoubtedly undertones. If you talk to anyone in the streets, in business, in our community, both real estate, mortgage, things are interesting. Things are slowing down. Buyers are less confident. We're seeing, a lot of uncertainty with our clients, and the overall outlook is not super strong. Yet Chairman Powell was very direct in saying, hey, yes, we're not at our 2% target with inflation. We're seeing the economy is incredibly strong, and we're not terribly concerned with unemployment. Yet data that has been received, and that the bond market and other financial aspects are looking to really paint a much different picture. So it was almost as if, hey, this was a huge buildup for the Federal Reserve, and boom, nothing. So with that, we saw, for a normal Fed week, this type of non-movement in the bond market, which again controls mortgage rates, it was as if it was a non-event week. So that pulls our eyes to next week with CPI, Consumer Price Index, the inflation reading for the consumer side, and definitely eyes will be on that. But here, the expectation through the duration of the year is, yes, rate cuts are coming, yet we don't know when. And yes, the bond market has ultimately priced those in. So something we're going to continue to monitor. And yes, we'll continue to update as that comes forward. The other things this week was interesting developments in trade talks. It appears, a trade deal was struck with the UK, and it looks like China is coming to the table as the administration is meeting with them in Switzerland over the weekend. So bond market is acutely attuned to the outcome of that and ultimately what that means for other negotiations and deals going forward. So I know the bond market is really kind of eagerly watching and waiting. I know stocks are responding positively, and hopefully we catch those windfalls on this end. With that said, the tip of the week and what I want to ultimately close with is we get so many questions during these Fed meetings. Hey, the Fed cut or left rates alone or hiked rates. What does that mean for mortgage? Hey, why didn't my rate drop because of that? Whatever the output from the Federal Reserve, the client's response is usually in tone with that. And we have to lead with authority and clarity to ensure that we're coming from a position of knowledge to our client base. So the Federal Reserve, yes, they control rates, but those rates are tied to short-term debt, such as auto loans, HELOCs, home equity lines of credit cards, so on and so forth. Now, there is a correlation. However, that correlation typically picks up long-term, but mortgage rates specifically are tied to more long-term duration debt, such as the 10-year treasury, and yes, ultimately the bond market. So here, when we see moves from the Federal Reserve, it's not uncommon to see the opposite response within mortgage-backed securities. Fed cuts, we could see rates go higher. Fed hikes, we could see rates go lower. So having this knowledge and presenting it to our clients to ensure that they're informed, and again, you're coming from a place of knowledge and authority, ultimately puts you in the driver's seat. As always, if you're running into challenges, need questions, know we're here to support you. And yes, it would tremendously help us, as well as if you like, subscribe to our channel to ensure that you're up to speed at all times. As always, let's make it a great Friday and an even greater weekend. Thank you.